Hi, welcome to the East Asia Econ YouTube channel. My name's Paul Cavie. I'm the founder of East Asian Econ. We're a platform for tracking and understanding the big economies of East Asia. That's China, Japan, Korea, and Taiwan. We have a deep data infrastructure that allows us to do that. And the idea of that is to build insightful and actionable insights that will be helpful to investors. And I'm going to talk about one of those today, which is what's happening with China and whether we can start to talk about a floor for deflation. Now, that is what I want to talk about. But I want to sort of start with like three requests to begin with. The first is, if you find this video interesting and it does add to the insights and help you understand the region, then please subscribe on the website and also think about sharing it with your friends who might be interested in the work that we're doing. That would be greatly appreciated by me. The second thing is, again, if you're interested in these kind of issues, please check out our website, eastasiaecon.com. On there, you'll find a lot of available data infrastructure, so you can look at some of the data visualizations that we have for China in the region. You can look at some of the charts we have, and you can sign up to receive some of the occasional emails that we produce. The third thing is, if you're a professional investor, then please get in touch. East Asia Econ is really designed for you. We're trying to do a lot of detailed cycle and structural analysis of these economies. We have a lot of output that comes out every day, and it's really targeted at professional investors who are interested in the region. And so if you're one of those and you like the sort of work that you hear today, then do please get in touch with me directly. Now, apart from all of that, on with the show. As I said, today what I want to talk about is deflation in China. And I want to try to make the argument, or maybe explore the case, that actually we're seeing a floor in deflation for China. Now, why really focus on this? There's two obvious reasons. One, because deflation clearly has been a big macro issue for the economy throughout the course of the last 3 to 4 years. We can see that in PPI, in CPI, in property prices, and until over the course of the last year or so, also in equity prices. The GDP deflator has been negative for several quarters, and this is all something that's very negative for investor sentiment towards China. It's very negative for real interest rates, and it's also very negative for profitability of companies. So this is something that really matters for the economy. The second thing is, there's a lot of talk, loose talk perhaps, but still nonetheless, there is quite a common perception that this is a deflationary spiral. And people like to use this phrase, deflationary spiral, and that's what's going on in China. And that really is one of the things I wanted to start off with, that it's not really like that. I think, and actually even in Japan, it wasn't really a deflationary spiral. There's a low rate of deflation in China. Prices are falling. But it doesn't look, there's no evidence, I think, that price deflation is getting worse. So that's maybe a pedantic point. But the other things I wanted to talk about is then why we might be seeing a floor in deflation anyway. Low rates of deflation start to come to an end. And in that, there's a cyclical part to the argument, and there's a structural part to the argument. So first of all, let's start off with the cyclical part. And to be honest, the cyclical part is low conviction. I think there's some interesting things to say, but this is not me pounding the table. If I had the table here, it's not me pounding the table and saying things are really changing. But there are some signs of a shift. The structural side, I think, is much more powerful, and that's something we'll talk about after the course of a few minutes. First of all, though, what could we say about the cycle? Why could it be that deflation is starting to bottom out? And I think there's three things I'd point to. First of all, if we actually look at the data, it is suggesting that over the course of the last few months, the rate of deflation has begun to decline. Again, we can see that in PPI specifically. So if you look at some of the upstream price series that China has, the high frequency data, it basically looks like the level of PPI hasn't changed since June. So it was declining before then, but since then, the rate of PPI deflation on a month-on-month basis has been zero. So that is a change. So that's one thing to be noted. The second thing in terms of CPI numbers are still quite low, and particularly in terms of services prices, there is no sign that inflation is starting to bounce back. However, from a headline point of view, it does look like food prices in China are now starting to rise, and that should be quite significant for CPI in the fourth quarter of this year and into the first quarter of next year with Chinese New Year. So the average of PPI and CPI does look like it's starting to improve. Why does that matter? Because of this chart. if you look at this, that would be a clear indicator that the GDP deflator is starting to lessen, and therefore the gap between nominal and real GDP growth starts to level out. Again, it's not the sure proof that things are changing, but at the margin, it is a positive change for the economy. The second thing is on the cycle, like how then could we justify this? Why would that be happening? And in terms of PPI, you have to look at things like what's happening with global commodity prices. You have to understand what's happening with the US dollar. All of these things matter. But domestically, there is one change I think that is important, and that is that the move of money from demand deposits into time deposits, which is something that has been very pronounced over the course of the last 2 years, it does look like that trend is now beginning to slow down. Now, how to think about that? That basically means that M1 growth has started to improve. And that is something that is very clear in the data. The M1 growth this year, after being negative last year, has bounced back. Now, again, like there's some statistical problems with the data, particularly in terms of the way that M1 has been calculated, where historically it was based only using corporate demand deposits, not looking at consumer demand deposits. That's why I tend to look at this ratio here shown in this chart, which actually looks at household demand deposits relative to household time deposits. But this is an important indicator. Historically, it has been an indicator of change in the economy. And the sort of the intuition, I think, around that is that people tend to hold more money on demand when they want to use that money to do something. So it's an indication that things are beginning to improve in the economy. Whereas if I'm a consumer and I put all of my money into 3-year deposits, it basically means I don't really want to do anything with it at all. So historically, this indicator has been a sign of change in the economy. And again, it does look like it's now not beginning to worsen anymore. So we've got two things. First of all, actual data in terms of prices. The second thing is some of the fundamental stuff, in particular in terms of these money flows. The third thing, which is, to be honest, a bit more tentative, is what's happening with the property market. Now, 3 months or so ago, I would have said that the property market is probably beginning to stabilize in terms of construction. The reason for saying that is because property starts had fallen by about 75% from the peak. So a remarkable fall, really. And as a result, it didn't look like starts were getting to fall anymore. Now, since then, in terms of the last couple of months or so, property starts have indeed started to fall once again, as this chart shows. So again, it's a bit of a tentative point, and this renewed weakness in the property market is something which gives me more concern about where the economy goes cyclically. So it's not something where I would be pounding the table and saying things are definitely turning around. But I do think with property starts down so much, it is becoming difficult to see how they fall that much further from here. So I think we are in the situation where we're moving through at least the first stage of the government's attempt to jettison property as a driver of growth in the economy. That's been very negative for growth in terms of the delta over the course of the last 3 years. That delta is now becoming less precisely because property can't fall that much further. And so I think there is that context to have in mind when thinking about where the economy goes from here. The other thing I think in terms about thinking about the cyclical picture in China is this chart. And this chart is looking at my estimation of the People's Bank of China's reaction function. Now, it's a simple idea, right? So we're trying to find things which correlate with the decisions of the central bank over the course of the last 20 years that have prompted the central bank either to raise rates or to cut interest rates. What does this chart show? This chart shows the likelihood that the People's Bank of China eases policy from here. What it shows is that for the first time, really since 2021, the probability of an interest rate cut or reserve requirement cut is falling. It doesn't mean it's over. It doesn't mean that they necessarily are now on hold. But I think for the first time in the last 3 to 4 years, the probability that the easing cycle in China is finished is starting to rise. And I think cyclically then, that's quite important. And we can add that to the other things that we've talked about, what's happening with the property market, the shift in time demand deposits, and also the inflationary picture that will suggest there is a change in what's happening with the cycle. So again, that's my cyclical picture. Prices do look like they're a little bit less negative than they were. The time deposit stuff, I think, is important in thinking about where the cycle goes. The third thing is property, which looks a bit more tentative. So I think some evidence that at least in the next 6 months, deflation stops getting worse. Now, the second thing, which I think is much more interesting and powerful, is really thinking about the structure, like thinking about the kind of the bigger structural theme of deflation in China. And I wanted to start that by thinking about three different examples and going back to that idea of a deflationary spiral, like when there's periods of quite strong deflation that persist for a number of years. And I have three examples to think about. The first is Hong Kong after 1997. Now, Hong Kong had deflation, right? Real interest rates rose, the property market came down very sharply, all of that happened. Now, why did that happen in Hong Kong? It happened because Hong Kong was a very expensive economy in 1997. Property prices went up a lot before the Asian financial crisis. Level of CPI was quite high. We can all see that, get that reflected in the decline in the trade surplus and the proxy for the current account surplus going into the late 1990s. Hong Kong became an uncompetitive economy. When the Asian financial crisis hit, what does that mean? Hong Kong had to regain competitiveness. It can't do that through the currency because it's a currency board which links the Hong Kong dollar with the US dollar. Currency didn't change. Therefore, the only way that Hong Kong could regain competitiveness was for the domestic price level to fall, reflected in property prices falling and other prices falling as well. There was a specific reason why Hong Kong had deflation. The second example is Taiwan. Now, in previous videos, I've highlighted that Taiwan is the economy most similar to Japan in terms of the inflationary experience over the course of the period before 2020. So Japan had deflation during that period. Taiwan had a bit of inflation, but core was only running at 0.4% a year. So basically no inflation in Taiwan. So why did Taiwan have a deflation? Again, I think one of the big explanations is because Taiwan, relative to mainland China, was quite expensive. And it is relative to China that is the important point here, because after in the run-up to China joining the WTO, there was this huge move of manufacturing from Taiwan to the mainland. As a result of that, Taiwan started to look very uncompetitive in terms of manufacturing wages relative to the price levels in China, and that was something that therefore put pressure on prices to fall. Now, again, in Taiwan, we're through that period now. It looks much like wages have started to increase once again in Taiwan. This is all because of TSMC and the semiconductor cycle. That's why this deflationary period ended. So that kind of competitive issue is no longer the issue that it once was. The third example we can think of is Japan. And Japan is obviously the quintessential example of deflation, deflationary spirals, persistent deflation, right? All of these things that people worry that China might have now. Now, again, I think Japan, we've talked about this in previous videos. You can look at least 15 different reasons why Japan had deflation for so long. So there's some very specific causes of what was happening in Japan. But I think there's also a big picture thing to be bearing in mind, and that is, again, that Japan was very expensive. And we can think about that expense level in two ways. So one, just thinking about in terms of the yen. So into 1989, when the bubble burst, the yen was already appreciating a lot because of the Plaza Agreement. The bubble then burst. By 1991, PPI deflation had already taken place in Japan, which was to persist until about 2001, the dot-com bubble or thereabouts. So the first bout of deflation had already started. And yet, in the first half of the 1990s, the Japanese yen appreciated by another 70% or thereabouts. So what does that mean? The price level in 1989, if you speak to anybody, right? So I moved to Japan for a year in 2015. At that time, lots of my friends are saying, Japan, isn't it really expensive? And there was this perception back in the 1980s and 1990s that Japan was this very expensive place. And by 1995, it had become incredibly expensive because the yen had continued to appreciate. And you can get a sense of that by looking at this chart, which is based on BOJ methodology. It looks at the relative price level in China compared with the rest of the world. It looks at the relative price level of Japan compared with the rest of the world. And you can see that in 1995, Japan was a very expensive economy. What does that mean? For a long period of time, Japan had to regain competitiveness. Now, that can either happen through the depreciation of the exchange rate, and we're obviously seeing that in spades at the moment. But the other way it can happen is reductions in the domestic price level. And that then is something that happened for years because the price level in 1995 was so high. So that, I think, is important structural perspective in terms of thinking where we are with China today. So let's look at China in that framework. In this framework of thinking about whether China is losing competitiveness, whether it's an expensive economy, where there's a good fundamental reason why prices should continue to fall. And I think we can do that again in two ways, using that framework of Japan. First of all, let's think about the CNY. So the currency in China. And the currency in China is not expensive. So over the course of the last 3 to 4 years, like a period when a lot of people would say a bubble has burst in China, as it did in Japan in the 1980s. Again, in that period in Japan, the yen appreciated by 70%. In China, the real CNY over the course of the last 3 years has depreciated by about 20%. The CNY in real terms in China is now cheaper than at any time since 2013. It's not an expensive economy. It's not an economy that's losing competitiveness because of the changes in the domestic price level that we're seeing. The second way of looking at it, again, is to use that BOJ methodology for thinking in price levels in an economy relative to price levels in other economies. And again, looking at this chart, it shows the same picture. Unlike Japan back in the 1990s, China today, relative to its major trading partners, is not an expensive economy. Now, of course, when we think about some of these big macroeconomic dynamics like inflation, which, frankly, a lot of people will think is still very misunderstood, like there's a lot more things going on than just thinking about like the relative price level, like thinking about competitiveness. But it is one of the things, right? Like it is something that should be important. And I think about thinking about China in this way, it's like a fundamental reason why we should be skeptical that it's necessary the price level in China continues to fall for a long period of time. I think it's just as arguable looking at this kind of data and thinking about China in this framework, but actually there's good reasons why the price level should start to find the floor, because it doesn't add up if the price level continues to fall further from here because of the level of competitiveness that China has already achieved. Now, of course, and again, I think there's the other things we should be thinking about in terms of getting a good sense of this and coming up with a stronger structural story is one, if and when the property market does begin to bottom out, how much downside is there really left in property? The second is obviously trying to understand the supply side dynamics in terms of the manufacturing sector, the lending growth that has been happening that's allowed capacity to continue to increase. Now, those are relevant issues, but I don't think that they necessarily justify the sort of pessimism about deflation or at least the conviction about deflation that it's going to continue in China for a long period of time. I would suggest that there's other things to be thinking about, which would just suggest that prices quite possibly will start to bottom out. Now, what's the market implication of this? Like how to think about that? I think there's two things that matter from here. One, what does it mean for nominal interest rates in China? Now, about a year ago, when we made a video did some research and then made a video looking at this comparison between China today and Japan back in the 1990s, one of the arguments of that was it's likely that interest rates in China have probably bottomed out. Now, I think if you look over the course of the last year, that isn't an unreasonable estimation of what's happened. It's been a bit bumpy, but interest rates haven't continued to fall further. Now, it's a bit of a sort of artificial victory, if you like, because interest rates are only about 1.5% for the 10-year. How low can they really get? Nonetheless, I think a lot of people were thinking that interest rates would come down further, and that isn't actually what's happened. And so I think that is important. So as I've said, like it looks to me like interest rates probably have bottomed. I think that makes sense given the PBC's reaction function that I talked about earlier, with the lessening probability of a cut coming through. And then the significance of that in another way is what it means actually for the CNY, and whether if we have seen a floor in interest rates, it becomes much more likely that we've also seen a ceiling on dollar CNY going higher from here. Now, again, to get excited about thinking that there's going to be CNY appreciation, which I think fundamentally would make sense. But to get excited about from a cyclical perspective, we need to see much more evidence that inflation really is turning around and starting to rise. And really, we're not there yet and won't be there until the property market starts to recover. But there are, again, second derivative changes are important. And it looks to me like interest rates have probably stopped falling because the deflationary risk is probably a bit overstated at the moment. And that sets the context where the CNY can start to be more stable. So again, I'm Paul Cavie from East Asia Econ. We're a platform for understanding what's happening in the East Asian economies. Today, I focused on China. If you look on the website and the other videos we've done, we look at what's happening in the other economies as well. I hope you found the video interested. If you have, please subscribe. And if you have any questions, then please get in touch with me directly. Thank you for watching.